Good morning, good afternoon, and good evening, everybody, and thank you so much for joining our webinar today. Today, we are going to talk about revenue accounting and lessor accounting. We're going to focus in really on how SAP provides a complete holistic solution for lessor accounting, something that I know a lot of people haven't been thinking about or haven't really thought about SAP for. So we're going to talk about that. I have three great guests on the phone today. With us from all over the place today, all over the US and way down in South Africa again. So welcome Sarah, Julio, and Sharish. All right, so let's get started. Just some brief reminders for everybody. The webinar is being recorded, so feel free to share that with anybody. Check it out again if you want to come back and review some of the things that you've seen today. Again, feel free to ask questions throughout the session. Last week, our project systems webinar had some great questions, and we were actually able to get to all of them. So please feel free to ask questions. We're here for that. And then, of course, you can download our previous webinars from our homepage. Go check it out at bramasol.com. You can also check out our webinars here on YouTube. We have a whole YouTube channel. We have a number of different videos and things available to you. Join us at Facebook, LinkedIn, or check out our Insights to Actions podcast. We have a great set of guests from not only Bramasol, but SAP, industry, all over the place. So check those broadcasts out on a variety of different topics. So let's dive into the subject. Julio, we're going to start with you. Let's talk about the introduction here. Revenue. Why are we talking about revenue accounting and lease accounting, particularly from the lessor piece?
Hi, John. Good day, everybody. So yes, so with the adoption of the new revenue accounting standard, ASC 606, IFRS 15, what happened was many companies had quite a significant impact on the changes, namely the adoption of a universal set of rules for revenue accounting, following a 5-step model. A couple of years later, we had the most significant change in the leasing industry, in the leasing business in over 30 years, where in the previous instance, many companies were using off-balance sheet financing to have leases, and they weren't required to report them on their balance sheet. With the adoption of ASC 842, almost every company had significant changes, but from the lessee side. From the lessor side, even though there was an adoption of ASC 842, sometimes what we have found is many companies have had changes, not necessarily because of 842, but actually because of 606, which is the revenue accounting standard. Because, John, if you think about the lessor and lessee, the lessee is the person who goes out and leases that piece of equipment. So therefore, they now have to record that financing transaction on their balance sheet. From a lessor perspective, it's quite the opposite. They actually own the asset, and they are now leasing that piece of equipment to customers. So it's a revenue transaction rather than cost transaction. So it's sort of the other side of the coin.
It is, and I know when you and I first started this journey 3 years ago, and we talked a lot about revenue accounting, we realized that we were always talking about the lessee side of the equation being the other side of the coin from RevRec, and we realized, wait a minute, those are all lessors. Let's think about this. There must be a great solution for that, and it turns out, of course, SAP does have a great solution for that, and we've been able to leverage it. So we'll talk about that. But maybe you can say, let's talk a little bit more specifically. What are those changes for lessors, Julio?
So I'll start out the conversation, John, with saying that there aren't as many changes for lessors as there were for lessees. So lessors will still continue to determine the lease classification, whether the lease is financing or a sale. So if you have a sale, it's a financing transaction, or you have an operating lease where the company retains possession. And we will get down into that,
Yeah.
closer as we move into the demo. But essentially, taking the leadership from ASC 606, it's all about the transferring of control and what we call the risk and rewards of ownership. So in a very summarized way, if the lessor is transferring control to the
Mhm.
lessee, it could be deemed a financing transaction, which is a sales type lease, or if they're keeping control and simply having a transaction where they rent the equipment for a period of time, it's going to be considered an operating lease. So it's essentially ASC 606 has really kept the accounting for sales type leasing, direct financing leases, and operating leases. So there is some effect on the financial statements and disclosures. There's a new profit recognition requirement that will require lessors to take a more different approach when it comes to classifying these leases, whether it's a sales type or a direct financing type
Wow.
lease.
And we'll talk about those in a few minutes, right? Okay.
Mhm.
All right. So talk a little bit about that, because everybody doesn't realize that there are impacts, just like,
Yep.
the huge impacts. It was estimated that almost $3 trillion of assets would all of a sudden show up on people's
Yep.
balance sheets from a lessee perspective.
Correct.
But they didn't realize that not only were there balance sheet impacts, there were income statement impacts and cash flow. Same thing is true here of our two different types, our sales type and operating. Maybe you can talk a little bit about what those impacts are.
Yes, definitely. So on the top of the screen where you have a sales type and direct financing lease, the impact on the balance sheet is, once you've classified this, and this is the accounting classification as a sales type lease, there are two things that's going to happen on the balance sheet. The first thing is I'm going to remove that asset from either my fixed asset ledger or my inventory ledger. And then at the same time, I am going to add the investment in that lease, which what we call as a long-term receivable. That's the balance sheet aspect. On the
Mhm.
operating side, for the lessor, they will continue to recognize the underlying asset because remember, in an operating lease, transfer of control does not happen. Therefore, it will remain on my balance sheet as the lessor, and I will continue to amortize it on through my fixed assets schedules. On the income statement, what happens in a sales type leases, there's a very important transaction on day one. On day one, because we talked about we're de-recognizing the asset on my books, I'm de-recognizing the asset by actually selling the asset, which is effective sales transaction. So with the selling of the asset, I will recognize a profit or loss on day one. I have a gain or loss on sale of that transaction. And
Mhm.
then more importantly, where CLM comes in is you now have to create a new amortization schedule where I'm going to recognize interest income over the life of the transaction. On the operating lease side, on the income statement, this is pretty straightforward is straight line lease income will be recognized over the lease term.
Mhm.
Lastly, from the cash flow side, basically when I receive cash from that payment from the lessee, I'm going to receive that cash as operating cash flow because it's a transaction where I'm selling the asset, I'm receiving cash coming in. It's an operating transaction, not a financing, and not an investment. On the operating lease side, I'm going to start, continue to receive my cash received as operating cash flow, same as before.
Right. Great. All right. So before we dive into the system, I have a quick poll for everybody. I'm hoping a couple of quick questions or quick polls here. So let's start with the first one. If everybody wouldn't mind answering a quick question, um, you know, do you have, oh, let's see if we can do that again. Let's try that again. So do you have currently a lease solution? If you all could answer that question really quick. And I know as people are answering that, hopefully, well, is it gonna work? Apparently it's not cooperating. So we'll jump quickly to the second one. So let's jump to the second poll. Probably even more meaningful. So while you're doing that, while we're talking, hopefully everybody will see the poll. While we're doing that, Julio, maybe Shirish, maybe we can talk a little bit about the integration piece of this and the cash flow and the statements. Any thoughts from your perspective? You've done a number of these implementations. What are your thoughts?
So I think the integration is the biggest. Thank you, John. So the integration is the biggest piece because you want to be able to see all your information in one place. You want to be able to leverage the data that's already in your ERP system to be all in one place. And so having that integration between your revenue and your leasing basically gives it a very tight fit, because now you're able to pass the information from one solution to the other, and basically because it's integrated, you're able to see all of the information all in one place. So you can see from the time that you have acquired the asset to the time you have sold the asset, to the time that you have the cash flow, to the time that you have basically recognized the income, the revenue. All of that information is basically now in a single source within your ERP system.
Cool. All right. Thank you. All right. So we'll give another second. Come on, guys. We know you can. Only 32% of you have voted. Let's see if we can get a couple more people to vote, and then we'll wrap this up, and we'll talk a little bit about so what does SAP do, and how do we do that? So give it a couple more seconds. We'll close. Anybody wants last minute vote? 3, 2, 1. All right. So net is it's about a 60-40. Nobody here, good news for us, I guess, is there's a standalone solution, but it appears that about 2/3 of people are using Finance's favorite tool to manage this lessor accounting spreadsheets. So hopefully we'll share with you some information that gives you a perspective on a better way to do that. So Julio, you talked about this briefly. What is the connection between ASC 606 and 842 for lessors?
Well, there's a deep connection because lessor and lessee accounting is governed by ASC 842. On the lessee side, you have all the cost elements of it, which is recognizing cost. However, on the flip side, as a lessor, it's all about revenue and income, and specifically interest income. So that is the big connection, because even though you have a lessor transaction, you're actually in the revenue accounting space. So, I think, John, we always bring these two together, and a lot of people, people who are not in the lessor space don't really understand. But if you think about it from that perspective, it all makes sense that lessor accounting is driven by ASC 606.
Absolutely. Great. Good point. Some of the disclosures, anything you want to talk to you about here? I know we've talked a bit about it, but there's a few key points maybe you can make here on some of the disclosure updates, right?
Yes, I mean, as a lessor, the accounting and the reporting has not changed that much, but essentially a couple of points I wanted to make is you have to disclose what your selling profit was at your lease commencement. You also have to separately disclose your operating lease income, which is the interest income over the life of that sales type or direct financing lease. And then if you have any variable lease income components, you'll also have to disclose your maturity analysis of your lease receivables. So you have to put that in the 5-year bucket and say, over the next 5 years, I expect these lease receivables to be bled out by this amount every year for the next 5 years.
Right. And we have tools, and we can leverage what SAP has for tools, but we have tools to help folks do that. And you can check out other videos that we have on our whole suite of disclosure reports, both for lessee, lessor, revenue recognition, et cetera. So with that in mind, Julio, we made a distinction of there's really two different categories of leases out there, and let's kind of focus in on that for a moment, because it'll be important to understand that as we go through now talking about, so what does that mean from an SAP perspective and how do we help you do that? So operating type leases, those are the ones where basically the company holds the asset, revenue occurs over time, may include this idea of, and of course, as a RAR experts, we understand multi-element arrangements, but maybe you can talk for a moment about multi-element arrangements and bundles as it relates to operating leases here. What do we mean by that?
Yes, John. So operating type leases. So what happens is, from an accounting perspective, the asset stays on the lessor's books, and because it stays on the lessor's books, it has to be depreciated or amortized. That's the first important point. The second point is, this is no different than any type of, as we say in 606 language, over time transaction. So a service, sales as a service, software as a service, any of those multi-year fixed amounts arrangements that you have in revenue accounting. Now, usually in these type of transactions for lessors, there's a multi-element arrangement. What do I mean by that? A bundle. Well, let's take a good example that we're probably familiar with. If you are leasing photocopy equipment or copy machines in your office building, you may have 50 different machines, and you're paying $200 a month per machine to Canon, let's say, for instance. However, there's other goods and services within the contract. There might be, you have to pay for usage of copies. You may have to pay for ink. You may have to pay for maintenance. You may also have to pay for warranties. So all these goods and services in ASC 606 language are what we call goods and services that now bundle up into separate or distinct performance obligations.
Right.
So with that, John, I will turn that over to you to talk about the allocations and how can RAR help us in that scenario?
Yeah, no, that's a great point, Julio. I mean, if you think of RAR as a tool that does revenue recognition and revenue allocation, think of the multi-element bundle. Let's say that, in your example, Julio, that we are leasing that asset, we're leasing that printer for $200 a month, but it includes a number of elements associated with it. Like you said, the warranty, the maintenance, the installation. It could include paper, it could include the ink. Every single one of those has a value, and if all we say is it's $200 a month, ASC 606 says, no, you can't go do that. You must break that out and allocate that revenue across the individual POBs. And so that's why, when you think of a lessor solution, RAR fits this very well because it does that automatically. And it also allows you to change and update these things through contract combinations. And we're going to go through a scenario today. I think that'll be really interesting that we talk a lot about, which is this idea, and again, we'll talk about it more in the future, of the solutions economy or the subscription economy. And that relates to things like consumption models. If you think of, and we'll show a consumption model specifically for a piece of medical or life science equipment, but what if you lease the piece of equipment, but you include consumables as part of that process? It's still an operating type lease, but it has this multi-element arrangement to it. You have to value all of those so that you can appropriately recognize the revenue. So with that in mind, Julio, we also have this concept of the new thing is sales type leases, where the customer effectively takes control. What's so special about that?
And John, I wanted to just add in one more thing on operating type leases. Don't forget, as a result of that multi-element arrangement and that $200 a month, don't forget that now we are required under 606 to have standalone selling price for all those goods and services to now break out how much revenue we can recognize based on the SSP of those arrangements.
Perfect. Absolutely. Thank you.
So now going back to sales type leases. So this is effectively a sales type transaction, hence the name sales type lease, where the company, the lessor, is effectively selling the good or the piece of equipment to the customer. I won't bog you down with the accounting, but there's 4 criterion that goes to say if any of these criterion are met, one of them being if it's 90% of the present value, another one being if it's 75% of the lease term, those things are considered to be effectively selling to the customer. And they also may include bundles as well, as we talked about earlier. And then this is interesting because there's 2 transactions. There is the first transaction that is treated as a sale, and then the second transaction is treated as not revenue, but interest income and accounts receivable. So what happens is on day 1, you have the sales transaction, de-recognizing the asset, recognizing the sale. And then on day 1.1, you also have the creation of that long-term receivable that's going to be reduced every month by payments and interest income. And then you also have on the P&L, the interest income being come every month, where you're basically crediting your AR and debiting interest income, as well as cash coming in from the customer.
Right, and what's really interesting about that, Julio, and why this is, and we'll see in a moment, really, sales type lease is fascinating to me because it's really, we talk about the non-instrument elements continue in RAR, and maybe what we should have also said here is, by the way, RAR will still need to do the allocation of revenue according to the SSPs as appropriate, because it's that then drives the value of that instrument being treated as income and an account and
Yep.
the interest, right?
I think, John, that is the really crux of this whole discussion, is that at least from an accounting perspective, and I know you guys are going to talk about this shortly, but from an accounting perspective, you first have to, go into 606 and do the goods and services, the SSP, the allocation, and then once you're done with all the allocations and you have these performance obligations, that performance obligation then feeds into ASC 842.
Exactly. And it continues on even though you've transferred that asset, because it has to be able to close it out. And because of what we'll talk about later on, you can have modifications, and we need to keep track of that.
Correct.
So this has been great in theory, but I'm sure everybody on here wants to know, so how does this work in SAP? So let's talk for a minute about the operating leases themselves. And we don't care. We put SFDC, it could be SAP, it could be any CRM that you have. You've created an opportunity. And now that opportunity will then flow into SAP Sales and Distribution. You've created a sales order, and that sales order and the fulfillment and the invoices and everything will continue on. So remember that we're not affecting for the moment anything having to do with the fulfillment of that item, the delivery of that item, the goods shipping, any of the invoices. All that happens either in SAP SD. You might have other systems that you use for that process. We're using SAP SD as an example here. You could also, by the way, use SAP CLM for that process. But what then happens is that this information is fed into SAP RAR, into what we call the RAI monitor. And maybe in a moment I'll ask Sarah to talk about what is the RAI monitor. But as you see, it flows into SAP RAR. The RAI monitor then creates the contracts, and we look at the fair value. We then have a tool that runs a report, and we learn or find out if the allocation amount fulfills a threshold. It could be 80%, 90%. There are different aspects to that. But if it says no, well, then this is classified, and we're classifying it as an operating lease, and RAR manages all of that. And then RAR then feeds the information down to the FIGL, the SAP GL, and all of the appropriate changes and updates are made appropriately throughout the period, the life of the lease, the event of the lease, in the receivables. Adjustments are made to the lease revenue, et cetera. So Shirish, let me take a moment. Sarah, what is the RAI monitor? What is that?
Hi, John. Hi, everyone. So the RAI monitor is the Revenue Accounting Item Monitor. That really is the inbound processing tool that takes all of the relevant revenue accounting information from the original operational documents, and it allows for you to provide the correct information around how you're actually going to be recognizing the different material or the different line items. So what it does is it can take really any information from any operational stream, whether that is SAP or non-SAP, and it can turn it into a revenue accounting contract that allows for you to properly recognize that revenue.
Right, and there are lots of tools in the front, and if you want to learn more about that, certainly Sarah and I, and we've all done some great, there's some webinars you can learn more about that, but there's a set of rules engines behind that that allows you to be flexible in terms of how you do that. So with that in mind, think about the operating lease sits within RAR, and we're going to see, Sarah's going to show us a demo of that in a moment. But let's talk for a moment, and I'm going to rely, Shirish, on you in a moment to talk a little bit about sales type leases, because they're a little different. And the flow in the beginning ostensibly is exactly the same. We'll start with your opportunity. You create it in SAP CRM or whatever you're using for your order systems. It flows in, we create an order, we do the same process, but now as you go through the process and we've updated the fair values in the system, we've discovered, or we've learned, the report shows us that no, this is really over 90% or passes some other criteria. This is now a sales type lease. So Shirish, maybe you can talk for a moment about, so RAR now will continue to do the appropriate allocations. Let's assume, and we'll see this in a moment, there's a multi-element arrangement in here, but we distinguish the instrument. What then happens from a systems perspective to that instrument?
This is kind of a classic integration that we talked about earlier in action. So realistically, what's happening here is, you've done the separation between the instrument and the service. And so now the instrument fair value is passed on to CLM. And the CLM uses that information to create a CLM contract with the customer. So that's basically a lessor contract that's created in CLM. And then it also helps you create what is referred to as the internal rate of return for that instrument. And using these values, it can now produce a cash flow that is basically going to be your interest income, and it's going to be your payment on a per month basis. So it's basically going to generate all of that cash flow and for you to see. And then you can also basically, and then it goes the next step after the cash flow has been cleared is the actual posting that it does within the GL, where it's doing the interest income posting and then the receivables adjustment for the accounts receivable as well.
Absolutely, and Shirish, maybe you can talk for a moment. We make it sound easy. You're going to do an internal rate of return. You'll do an IRR. In that IRR, you'll be able to determine what that interest rate is. And because of the innate capabilities of CLM, you can talk a little bit more about the innate capabilities as a powerful lease engine on both sides of the equation, lessee and lessor. You're now able to determine that lease payment amount and split that out somehow. And how does that, you split it out from the value of the instrument, correct?
Correct. So basically using the value of the instrument and using the internal rate of return, it is able to split the payment and your interest income. And then, that's basically what you can see in the cash flow. And then, the posting will also accordingly happen based on what you will see in the cash flow into your GL.
Interesting. So there's a question about why was quote unquote lease accounting not built into RAR? I think the answer to that is lease accounting to a certain extent is built into RAR. It depends on what kind of lease accounting you're talking about. Lessor accounting, it does make all the entries. This particular piece was not built in to do that because RAR is really a revenue recognition tool, not a leasing tool per se. Any thoughts on Sarah or anybody on that?
Yeah, I mean, this is basically, there are two distinct operations that are happening. One is leasing and one is revenue recognition. And, we have basically now tied the two together. But as far as, functionality is concerned, there are really two distinct operations that are happening. And so even though the lessor accounting can also be done by CLM, what we have found is, it's more effective to do it this way, where you basically, CLM is taking care of the accounting and the processing for lessor-based for sales type leases, and the RAR is for the operating type leases.
Absolutely. Yep. Thank you, Shirish. The other thing to note is because it is an integrated system, you can see here after we've determined it is a sales type lease, as Julio very well pointed out, we now de-recognize that asset, if you will. We move that asset out of fixed assets, which is where it was, and we remove it and we move it back over and we recognize it as a receivable, and we go through this process over here. So, it only works that way if you have an integrated solution like SAP. So that's great. This is a great theoretical discussion, and hopefully everybody gets a sense of where things happen. But Sarah, where does this really happen? How does, maybe we can turn to you and you can show us, so how does it actually happen?
Sounds good, John. I am going to take over.
Please do.
Let me know when you can see my screen.
I can.
Perfect. All right, everyone. So based off of everything we just discussed, I want to be able to walk you through both the operational lease as well as the finance lease. So I want to start with the operational lease. I want to start in a tool, what we've been talking about, the revenue accounting tool. So when I first come in, this is going to be an example of an operations lease that we have within revenue accounting. So when you come in, we were talking about how the inbound processing, the RAR items, then create a revenue accounting contract. That is what we're looking at here. It brings everything in from the original operational document, the contract that you have with the customer, the lease that you have with the customer, but it breaks everything down. So as you can see here, here's the original document or contract we have with our customer. And then here are some of those performance obligations. Performance obligations are really just a way to break out the revenue from the original contract. So I think earlier we were talking about an example of a printer. So within a printer, you could have the actual instrument or hardware itself. You could have ink, paper, a warranty on the printer, whatever those consumables may be, or the service. Those are then broken down. You could have just printer on, the lease with the customer, and then those are then broken down into the correct sanctions of revenue, basically, that you'll be recognizing. So we can see here the example that we chose is we're actually selling the customer consumables, and then they get the instrument and the service with those. But sold separately, that's everything that we'll be able to recognize for each of those items, and then it actually gives you an allocated amount. So although our contract may only have, whether it's the instrument or it's the consumables on the contract, we'll actually be able to break that revenue out and be able to recognize that here. What's great about this tool is although the lease comes in, it is able to actually break it out by creating that revenue schedule. So if we scroll across here, the system will then see that we have a start and end date, so we can recognize time-based revenue for some of our performance obligations, but we can also have different events. So the revenue might be recognized when you deliver a certain consumable, or over a point in time when you bill the customer, you'll be able to recognize that leased revenue or that leased income that comes in. It does that by breaking out a revenue schedule. So I'm going to go ahead and pull up the revenue schedule. The system will automatically break out this revenue schedule so that you can actually see at a point in time what your revenue will look like. So we can see here our contract started back in the end of 2020. We've got our instrument consumables. It'll tell us what can or is already recognized. So we have a recognized value up here and what has been posted. So when you bill your customer and then you're able to actually get the cash in from that revenue, we're actually able to see that recognized amount up above. And then all of our additional revenue that's over a point in time or over time is actually recognized, and we're able to see those dates attached here, and we can forecast out when we'll be able to recognize that revenue. Now, Julio, do you or want to add any additional comments here on the operational lease and some of the key points into how this affects those lessor contracts?
Yes, sir. I just wanted to point out to the audience that somebody asked the question, the difference between, ASC 842 and 606. I mean, what you're looking at essentially is a revenue contract. It's a revenue contract, and I think the important thing for me is to differentiate between people who are in the leasing industry versus lease accounting process. So this company may be in the leasing industry and they are now showing how they generate their revenue. So this is why using SAP RAR is the perfect solution, because it's nothing more than a revenue contract. Sarah?
Correct. Yep. Thanks, Julio.
One thing I want to just let me comment on this, because I think it's an interesting perspective here. Well, let me continue to the next spot, and maybe we'll talk about that in a moment. Go ahead, Chair.
Oh, yep. So the other thing I wanted to point out is, although there aren't invoices here, what's great about SAP RAR is it is fully integrated within the finance space. So it's not a module that lives outside of finance. It is embedded within the finance suite, and it has full integration into all the billing that's done within SD. So all the billing that happens with your customers within SAP, that's fully integrated into the revenue accounting tool. So we could drill back into the bills, we could drill back into the original orders and see all of those in line with your revenue that you'll be able to recognize for every performance obligation. John, do you want to make a comment here? I don't know if there's, this is kind of where I'm going to stop with the operations lease, and then we'll.
Yeah, I want to make a couple of comments and get some thoughts from Shirish and Julio. In specific, and maybe we can go back to the other screen where it shows the breakout of the different elements. Perfect. In the consumables and everything. So let's think about this for a moment. So Julio, this is an interesting example, because in this case, the customer was the company that we're working with didn't actually sell the instrument for anything. They basically gave the instrument away, but used the consumables as a way to pay for that. And we're seeing that more and more, particularly, Sarah brought up, rightfully so, a printer example, but think of this in the medical device space where you're selling reagents or consumables for swabs. We're all going through this COVID testing. Think about selling the instrument that does the COVID test, but all of the consumables that go with that, and how do you charge for those? And this is a fairly simple arrangement. Maybe you can talk a little bit about that, and then also talk about the idea that this consumables is based on some assumptions, and what happens and why is it important to have a tool like RAR when maybe they don't use 105 of this and 896 of that? It's different.
Yes, John. So if you think about the transition to 606, we always say in the accounting world that the idea of anything free goes away. And that is because even though customers may think they're getting something for free in the background, in the accounting department, they now have to figure out what is the standalone selling price of that free item. So in your example, even though they are getting the testing equipment for free and earning revenue from the consumables, in reality though, ASC 606 mandates that everything must be given a price. everything must have a standalone selling price, and that is how you allocate. So in the example we used earlier, where we have $200 a month for the printer, and maybe in the customer contract, it says the printer is free. Well, in the background, somebody now has to now say, okay, if I were to sell this printer to a third party at arm's length transaction, what would I sell it for? What would be the cost and what would be the selling price of that? And that might be $10,000. And therefore, that will be the standalone selling price, and that will be what I have to allocate to the printer. Now, the $200 a month might be for 5 years. It might be, $100,000 total contract value. But my bifurcation of that has to be, I have to now take away and allocate $10,000 from the total contract value of $100,000, the value to that printer. And that is what ASC 606 mandates. Now, why is that RAR is the right tool for this? Because that is what RAR does best. RAR was specifically built for multi-element arrangements and allocating multi-element arrangements based on standalone selling price. So basically, if we have that transaction, RAR will pull that $10,000 standalone selling price towards that performance obligation of that printer, and then allocate the other consumables, again, based on standalone selling price or residual value, or however way the company does the allocation.
Exactly. And we all know, and we'll talk about this later on, but there are modifications, and we'll talk about those in a little bit because the tools are designed to handle that. So Sarah, now we've talked about operating leases, but sales type lease kind of a little bit of a different animal. How does that work?
Correct. So that's going to look a little bit different. We will go into a different screen of viewing it from more from the lessor on the leasing side. So instead of looking at a revenue accounting tool, we're actually looking at the contract and lease management tool. So this is where it comes in. It says, here we're looking at our contract with our customer. It's going to give us our dates of that contract. So we're looking at a 5-year contract with our customer. We can see the contract value or the term that we're looking at, that overall expected income that we're looking at, $2,000 a month for that instrument. What we do is we actually bring in the instrument from the financing side. We'll bring it in and actually be able to integrate the lease or the leased object with SAP fixed assets. So it allows for us to have the object type. So we're looking at an instrument, and then we're actually able to showcase that with fixed assets. What happens is the system will generate a valuation for this particular lease. So we're looking at a leased asset with our customer, and it'll actually give us that valuation for that overall contract. Mm-hmm. The most important piece within a financing lease is after we've got the valuation, we've got the equipment fair value, or we're able to calculate the equipment fair value based off of the initial IRR that we brought in. So we've got our original value. It looks like here for this particular lease, we were looking at a $2,333 value and the initial IRR, which gave us our fair value. And then if there are any changes down the way, it looks like 2 months in, we changed our lease price and our IRR went down, and so we'll get a new calculated equipment fair value. Mm-hmm. I do want to pause here and ask Julio and Sharish to just kind of jump in and talk to a little bit more about how we integrated the calculation of the IRR with the overall lease for the lessor leases.
Yeah, so the equipment fair value is a value that's passed on from RAR. So, we are using the information that's being passed on from RAR, to be able to estimate the internal rate of return. So as I mentioned earlier, that's where sort of the integration we have determined based on the parameters, where we're checking to see whether the allocated amount is going to be greater than or equal to 90%. And when it's estimated, yes, that this is going to be a sales type lease, that's where we're passing down the value of the fair value, and then using that information to be able to calculate the internal rate of return. And that helps us in generating the interest and the cash flow. And so, as I said, in the next step, once we have reviewed this, we can also evaluate it using these parameters. And then when you go to when you look at the entire cash flow, then you have the option to be able to post these to the relevant receivables and the income accounts. So that would be sort of the next step. But this is kind of showing you at a high level within the cash flow, using this level, this value of IRR, what would be my interest look like? And I think what we are seeing there a little bit later is, okay, my value has now actually gone down, so that correspondingly my interest is now lower.
Mm-hmm.
Awesome, thanks, Shirish. So another thing that you can do is, once you have these values, what's great about this tool is that it gives you an overall view into the cash flow. So you've got original postings against the asset for that fair value. So originally had that fair value of 120,000. Looks like we made a few payments against this particular lease here, clearing out. We've got that lease income that was expected for the 2,333, as well as those interest payments. And then it looks like they did a revaluation and actually got a different present value when they lowered the price. So whether that was a contractual discussion that the customer came back and said they only want to pay 2,000, or there was some kind of discount that was given after a couple of months, then it gave them the new interest rate as well. What's great about this tool is it actually has drill down capabilities. So we're looking at here in that interest, we've got those different financial documents that are given. So if we wanted to drill all the way back into an accounting document, we're actually taken back into just an SAP financial accounting document, which gives us that interest income that we would be expecting of that 736 against that asset there.
Great. Mm-hmm.
So this was basically transitioning or the integration between CLM to GL.
Correct. Yep.
And of course, the fair value and the values that we've passed, we've shown here. We show you what happens in CLM, but assume everything else is still happening in RAR. We've already allocated and are still taking. So remember, you've got two things going on at once. All of the other pieces of this multi-element arrangement or this lease, it might be motorcycle service, it might be tires, it might be other things that are included. All of that is still taking place in RAR, while the instrument itself, because of the valuations, and it's been moved, the instrument or the motorcycle, the asset, whatever it is, has been moved to the customer's books. CLM is taking care of all of that, and because of the seamless integration between the two, you can connect the dots between any one of these, whether it's the sales contract, master data on vendor, customer, all of that relates to one another, right? So, all right, anything
Correct.
else there, Sarah?
Yep. Nope, that's it. Thanks, guys.
All right.
I'll turn it back over to you, John.
Well, I'm going to see if I can take back and share my screen. Sarah, it doesn't want to let me share my screen. Oh, show my screen. There we go.
Try now.
All right. So let's dive into something more. So that's great, and I think it's pretty simplistic when you think of the process. You have operating leases, you have sales type leases, and we're going to talk for a moment about modifications. Operating leases with no conversions. Your operating lease, somebody calls up, they renegotiate their lease, maybe they add something to it, take something away from it. As long as it doesn't meet that threshold that we saw, there's no conversion, that lease is going to continue in RAR as normal. The same is somewhat true for a sales type lease, if there's renegotiation of the interest rates, if there's anything going on with respect to that. Again, the non-instrument elements will continue in RAR. The instrument will be updated, and we saw that when Sarah showed us that in CLM, and that will continue on, and we'll see the appropriate entries into the journal for the AP or the AR and the interest income. But what happens now in the case where we have operating lease and the operating lease becomes a sales type lease? We're going to make some updates through RAR. We're going to do some reporting. Let's take a look at how that might look, because what needs to happen now is you're taking what was an asset on your books, now you're changing it to something that's being transferred to the customer. And before we look at it from a systems perspective, Julio, can you comment a little bit about that unique aspect of what happens when something moves from an operating lease to a sales type lease as it relates specifically to the asset itself?
Yes, John. So in your example, a customer is leasing, has an operating lease, and then there's a modification, there's a renegotiation of that lease, and it converts to a sales type lease. Well, a couple of things has to happen. The first thing is that the reason why you're converting to an operating to a financing lease is because something was triggered as a result of that modification. So maybe you had a 5-year lease term, and maybe there was a 2-year life on that asset. It might be a computer. And then all of a sudden, in the renegotiation, you extend that lease to 5 years. Well, then all of a sudden, based on our 75–80% of the lease term being equal to the fair life of the asset, you now have one of the triggers being converted, and now you have to convert to a finance lease. So that will trigger the modification of that lease in that scenario, John.
Absolutely. So let's see how that happens in the system. So essentially, we have this modification that comes in, whether it's through your leasing system, whatever you choose. You've got updates to the sales order. It comes in as Sarah pointed out through the RAI monitor. We know there's a change. We've taken a look, we've pulled down the fair value, and now we're running this report or tool. And what we've learned now and we're looking at is, was there a change? If the answer is no, well, everything continues on in RAR as we pointed out before. But what if? And what happens, as Julio pointed out, SAP RAR will then, with the change, has to do a reallocation. That reallocation takes place, creates a value to that instrument. The value is then passed into CLM, where it does exactly what Shirish told us about and Sarah showed us before, where we take the internal rate of return, we split those up, and we create the appropriate adjustments to accounts receivable as well as allocating to the interest income. And you can see that because you have an integrated solution like we had before, all of this is possible. And all of this takes place in SAP. All of the data, all of the currencies, all of your master data is all the same. So the beauty of a solution like that is really that it sits within one SAP instance, one SAP solution, and that you see all of those flows through that process. So with that, I want to wrap up. Let's talk for a moment, and quickly, we have a few minutes left. One of the key benefits of a combined solution like this is the single source of truth. It's all about, I don't have spreadsheets for one piece, a lease solution for something else, and my ERP for another aspect of it. It all comes together in that single source of truth. Higher adoption with common interfaces. Now, instead of having 3 or 4 different interfaces, as you could see from what Sarah presented, we have a common interface. People get comfortable. They know their SAP. They know how it works, and of course, they're going to use it when they're comfortable with how that's being used. Shirish and the team pointed out the native integration. We didn't build APIs, we didn't build any tools here beyond what normally works. This is how SAP, from and the power of an integrated ERP like SAP, it's native integration. All of this is happening naturally. And of course, as you move from ECC to S/4HANA, it becomes even more powerful with the use of the SAP Universal Journal. Scalability and flexibility. We've talked to customers who do dozens of leases, hundreds of leases. You notice the motorcycle where they're doing hundreds of leases, all the way up to companies that are doing printers in the tens of thousands, millions of leases. SAP is scalable. You can see that it's flexible. It addresses many, many different kinds of leases, whether you're using a simple, straightforward lease like we saw early on, or you're using something that's a little bit more complicated, like the idea of consumables. And finally, security. This is all about making sure that your system is secure and nobody can make changes from it. You're logging into one source of the information, one source of the truth, but also one source of security so that you can have a single place to get all of your secure information from and manage that in a single spot. Since we're running out of time, I'm going to wrap up here. There was a lot of attention given to the lessee accounting under ASC 842. We heard a lot about that. We know that over $3 trillion of assets appeared, and there was a lot of work that had to get done. But ASC 842 did affect lessor accounting, and we're starting to see more and more of this model happening. And of course, there's the integration between ASC 842, and this is really a revenue type event and how those come together. SAP can be used for both of these. I think you saw here how we demonstrated that you can connect not only SAP SD or SAP CLM to this solution, but all the way through the entire process. You can see how SAP is connected, and you can have a single version, one place to go for your information, and that RAR and CLM can work together to provide a solution. And we talked about those key benefits. Key benefits being, the single source. It makes things a lot faster in terms of your implementation integration. As you go through upgrades in the future and you move from ECC to S/4HANA, both of these solutions basically work the same in S/4HANA as they do in ECC. Before I wrap up, any parting comments, Julio or Shirish?
No, I think you touched upon everything, John. I think the integration aspect, as we talked about earlier, especially as it pertains to master data, is very critical because this way you're avoiding to do a replication of the master data, user errors that may happen during the course of that, and there's a huge volume of master data that needs to be created for most corporations. And so, having that integration really gives a lot of benefit. So you're looking at the same version of the truth from different angles, and you'd be having to use the same master data across across the entire flow.
Awesome. Julio, thoughts? We'll wrap up.
John, I would just say that what we've presented today is a very unique and compelling solution where we've clearly shown that in the SAP space, we can handle the most complex type of lessor type accounting scenarios, operating leases, sales type leases, direct financing leases. It all can be handled quite efficiently in the SAP space without going outside.
Thank you, Julio. Sarah, as always, thank you so much for the awesome job that you do all the time. I just want to remind everybody that Bramasol is able to do this. We bring these solutions to you because we are the leaders with deep expertise in business transformation and finance, and across the leasing, revenue accounting, and deep expertise. Remember, not only does this have an effect behind the scenes, but as you're doing lessor accounting and we see more of these subscription models, you'll see more effect on cash flow in the treasury space. So look for more upcoming videos and webinars specifically around that space. And I want to thank everybody for joining us again today. Thank you again to my guests, Julio de la Costa, Sharish Kandakar, and of course, Sarah, all the way from South Africa. Thank you so much for joining us as well. So everybody, I want to thank you. Please stay safe and make it a great day.